How are homes and mortgages financed? Who pays for the construction of houses? How do you pay for your house? Where does the money come from? Which companies and households invest in the housing market? And what does your housing have to do with global financial markets? The largest amount of money most people spend in their lifetime goes to securing their housing, either in monthly rents or when they buy a house. 90% of Hungarians live in a house owned by themselves or by their family. How do people finance a house or apartment? Many inherit either money or a home. Others have savings. Many people don't inherit anything or don't earn enough to be able to put money aside. They need to take out a loan to be able to house themselves. Where do these loans come from? In international financial markets, there is a lot of money waiting to be invested. It is constantly growing and looking for somewhere to go. Traditionally, investors see the housing market as a good, stable place to invest. This is especially true when other sectors of the economy become too risky or not profitable enough. Investment money tends to channel into the housing market in cycles. This is something that happens everywhere. However, there are important differences in exactly how it happens in each country. In Germany, for example, there are institutional investors who have a much more important role in financing housing. Nearly half of the German population lives in rental housing, which is often owned and managed by larger companies. This makes it easier for institutional investors to put their money into German housing. Who are these institutional investors? In Germany, in the years following the crisis, house prices started to go up. One of the reasons for this was that a lot of international institutional investors had begun investing in the German housing market. This was because, in the years of the crisis, the German market was a much safer investment than others like the Central and Eastern European ones. These could be more profitable housing markets, but were also more volatile. So when the crisis hit, these investors extracted capital from more peripheral European housing markets and invested it in Germany. In contrast, in Hungary, banks are the main institutions of housing finance. 90% of housing in Hungary is occupied by its owner. These individuals are the main investors in housing. For this investment, they use their own money and whatever individual loan or mortgage they can get from a bank. So now, let's follow the money on its way through the banks into the Hungarian housing market. Banks are the main actors of Hungarian housing finance. So what financial resources does a bank typically have? Banks attract money from financial markets in various ways. They also collect deposits and savings. Before the crisis, banks did not have enough capital from Hungary to finance all the mortgages they were giving out. The majority of capital they pushed into the housing market thus came from their Western European mother banks, or from international financial markets. However, in recent years, people started putting more money into savings accounts. This is creating pressure on banks to start giving out more credit again, since banks only make money when the money moves. How does money get from the banks to the housing market? One of the main channels is to finance real estate developers that build housing. This happens through so-called project loans. Developers have to present their projects to the bank, and they are judged on a case-by-case basis. Usually, only big real estate developers can meet these strict criteria. They are the ones that survive the crisis. They build in the best locations and sell at high prices. All the banks want to do business with these few companies, so they get credit on good terms. But of course, other real estate developers, smaller ones that build in cheaper markets, also get credit. only on worse terms. These are, for example, smaller companies of the construction industry, which build in the suburbs of Budapest or in smaller cities. This logic of project loans strengthens spatial inequalities. Large developers are building nice new apartment blocks in urban areas for the affluent. Many of these inner-city flats are then sold for investment purposes. For smaller or newer companies, it's harder to enter the market since they get worse financing. Individual mortgages are the other way money flows from banks to the housing market. Before the crisis, there was a huge mortgage boom in Hungary. During this period, many people got housing loans who previously could not. This was a way for them to solve their housing situation, but this came at the price of a huge debt risk. In this period, mortgage lending also spread out spatially. Banks were giving mortgages in more and more places, also in localities which had been previously excluded. These more accessible mortgages were especially important in settlements where people had less money to buy a house on their own. However, this led to massive household debt. After the crisis, this bubble burst. Many people started defaulting on their mortgages. This led to an important social and political crisis, the effects of which we still feel today. In this post-crisis period, money flowing to the housing market almost completely dried up. About 2 years ago, mortgage lending restarted, but in a much more selective way than before the crisis, both socially and spatially. This means that newly issued mortgages mainly go to better off real estate markets and to better off social groups. In the meantime, 140,000 Hungarian households are still struggling to pay back their previous mortgages. They are the ones that all the government measures of recent years have not helped out of the debt spiral. 70% of these people live in smaller settlements with inactive housing markets. This means that they don't even have a chance to sell their houses, and thereby free themselves from debt. This spatial pattern is a consequence of financial over-inclusion in the years before the crisis, when households who couldn't afford it got loans. Because of the big mortgage crash after the crisis, the government started tightening up lending regulations. Also, banks now have much tighter postcode lists. This practice is called redlining in the theoretical literature and means that banks assign neighborhoods to different categories according to their riskiness. The riskier places will get more expensive mortgages, or possibly none at all. The third important channel for investing money in the housing market in Hungary is through individual investors. For those who have the money, the current environment of very low interest rates makes it more sensible to take their savings out of their bank accounts and put it into real estate. This is a safe investment with high returns. Their patterns of investment are very uneven. They usually buy flats in downtown Budapest and a few university towns where they know they can easily rent them out. This is not an institutionalized rental sector. Even the largest investors have only 10 to 20 flats. However, it opens channels of high profit for those who have this amount of money to spare, and also pushes rental prices extremely high in these selected locations. To sum up, a housing structure based on individual ownership and debt necessarily leads to increasing inequalities. It creates a situation where core housing markets receive a lot more investment. This is where real estate companies and households get financed on better terms, and this is where house prices start rapidly increasing as a result. In the suburbs and smaller cities, the housing market fluctuates a lot depending on state subsidies available. These areas are typical residential locations for families taking mortgages with the help of the child-based family housing subsidy. While in core regions and urban areas, housing does actually become a form of investment in many cases. In these intermediary housing markets, people usually buy to secure their own housing, where channeling money into the housing market is mainly just about having a place to live. Then there are the ever-growing peripheral housing markets, where house value and prices are dropping since the crisis, where it's impossible to sell and move elsewhere, or where 90% of existing housing transactions are just about getting out of a previous mortgage debt, or where houses are so cheap that the family-based housing subsidy can be sufficient in itself. In these places, it is especially obvious how private property can become a trap. Of course, the development of the housing market largely depends on employment possibilities and income levels in a given place. But there is also a reverse effect. The accessibility and affordability of housing determines who can live where, whether they can move or not, where they can take a job, and what opportunities their kids will have. If we leave this to the market, the spatial inequalities of the housing market